Good afternoon from London. You're here for this afternoon's FS Club webinar entitled Deforestation-Linked Sovereign Bonds, a Nature-Based Solution. My name is Simon Mills. I'm Senior Researcher at Zien, and in a minute I'm going to guide you through this afternoon's proceedings and introduce you to our guest speaker, Peter Elwin. But before we begin, I'd like to offer a word of thanks to our sponsors who not only give us a wide-ranging brief for these webinars to wander through the halls of politics, economics, science and history, but also allow us to open them to the public. If you'd like to know more about the FS Club, please do drop us a line. Now, the format for today's webinar is quite straightforward. You're going to be shot of me in a minute and hear from today's star turn, Peter, following which there will be time to explore some of the issues that Peter is going to raise in more depth. This webinar is recorded and you can revisit it or any of our previous webinars on our website. If you've got any questions you'd like to put to Peter, please use the conversation tool on the right-hand side of the screen. I'm going to be consolidating your questions as Peter is talking, and I'm going to put them to him at the end of his talk. And so, to today's speaker, Peter Elwin is a luminary in the field of sustainable finance. He's the Director of Fixed Income and Head of Land Use and Textile Programs at Planet Tracker, and has over 20 years financial markets experience, including as the Head of Research at the University Superannuation Scheme, one of the UK's largest private pension schemes, with over £60 billion under management. Peter, tell us about deforestation-linked sovereign bonds.
Thank you, Simon, and good afternoon or good morning to everybody, depending upon where you're dialing in from. So deforestation-linked sovereign bonds, this is something that the organisation I work for, Planet Tracker, has really just begun to promote. And what I'm going to do this afternoon is give you a little bit of background. I'll trot through things fairly quickly because I'm very keen to make sure there's plenty of time for questions at the end. And do feel free to sort of pop them in the chat, as Simon was saying. We'd love to spend a bit of time discussing and debating with you. This deforestation sovereign bonds are a very new idea, but the sort of, if you like, the underlying, what you might call financial technology is quite a lot older. So if we go to the next slide, I can begin to give you a little bit of the context. Now, one of the challenges, as always, with sustainability and the financial markets generally is terminology. So I'm going to refer to the family of bonds that I'm talking about here as ESG labeled bonds. Some people would call them green or sort of sustainable, but those terms are used in slightly more specific ways within this family of bonds. So let's use the term ESG labeled as the overall sort of genus, if you like. And then we're going to zero in and actually end up talking about the brown section on this graph of performance bonds. But I'll give you a little bit of an overview of the other side of the equation first. So if we jump to the next slide. Now, ESG labeled bonds can be divided into broadly two camps. Camp number one in blue here, the use of proceeds bonds, where effectively the person raising the money is making a promise about how they use that money. So they're tying their hands in terms of the use of the capital. And then the second alternative, which I'll come on to in a minute, which I've labeled performance bonds here, which are where the user of the capital is making promises about their future behavior or their future performance, not how they will actually use the proceeds. So if we just quickly trot through use of proceeds bonds first, and the reason why I want to just concentrate on them, yeah, thanks, do go to the next slide. The reason why I want to concentrate on them first is because they are by far and away the most common at the moment. So if you look at sort of, the broad reviews of ESG labeled bonds that are being sort of shown across the sort of financial markets at the moment, the vast majority of the bonds being issued are use of proceeds bonds, sometimes abbreviated to GSS, green, social or sustainable, because those are the sort of the labels for the different categories within this overall category of use of proceeds. The key thing is that you issue the bond and you make a contractual promise that not only are you going to pay the money back and you're going to pay a set amount of interest, as you normally would with a bond, but you are going to use the money you raise for a very specific purpose. So you are going to convert your energy supply chain into sort of green energy, or maybe you are going to use the bonds to apply to some sort of social purpose within your organization, and so on and so forth. So you make a promise around how you use the proceeds. Now that's very straightforward. It obviously then requires you to have a process for sort of evaluating the project in the first place so that you can get certification. Yes, this is legitimate. You have to have the proceeds, use of proceeds monitored, and then obviously you have to have a reporting mechanism around that. The slight challenge with use of proceeds bonds is, of course, that the amount borrowed cannot exceed the project spending. So you've got to be quite careful effectively to sort of under borrow relative to the size of the project. It's not like a normal bond where you can say, well, we'll use it to buy this kit, and if there's some left over, we'll use it to pay a dividend or pay our chief executive or buy something else that's nice or just spend it on working capital, normal sort of corporate purposes. The use of proceeds bond cannot be used in that way, so it's much more restricted. Now, the challenge comes in if you are a small country or a smaller company or even a large company but with a small project, because then by definition you'll be creating a small debt product. And that potentially is then a challenge when you try and market it into the financial markets. Investors will say, well, I'm sorry, that's just below our investment sort of threshold. It's too small to consider, won't fit into our portfolio. We're not going to get the sort of the payback in terms of portfolio returns that will warrant the effort of investing in this bond. So there's a minimum size in effect, not precisely defined, but a limit, a lower limit below which really it doesn't make sense. And that's particularly an issue for sovereign bond investors. Now, we have seen a few sort of green bonds being issued. We've obviously got the UK green gilt. We've seen Germany do a number of green bonds, and quite a variety of other countries have issued use of proceeds bonds within their sovereign bond framework. But if you're a smaller country, developing nations particularly, you're going to find it much more challenging because you literally haven't got a sufficiently large project to actually then get the attention of the financial markets. That obviously means from a corporate perspective, you're immediately sort of driven down the bank lending route. And we have seen banks getting more and more involved in sort of what you might call sustainable lending broadly, which was a substitute effectively for these use of proceeds bonds. But that's much more of a challenge for sovereign borrowers and not something that we've seen so far. So that then leads on to a much more sort of nascent area of the bond market, which is on the next slide, which is the performance bond side of things. Now, as I say, with a performance bond, you are not constraining the proceeds for any particular purpose. Instead, what you're doing is you're saying you will comply with certain sort of KPIs, and if those KPIs move, you will then promise to do something. And usually the thing that you're promising to do is, at least in part, to pay the investor in the bond a greater or lesser amount of coupon at any particular time. And it may also be that you pay them a greater or lesser amount of capital at the end of the bond's life. Now, a classic example that we're all probably very familiar with would be an inflation-linked bond. Obviously, the UK issues them, the US issues them, a number of other countries issue them, including Brazil, which is a country I look at quite a lot. And there you're basically, as a government or as a borrowing authority, you're tying your hands, you're tying your bond to the behavior of a particular inflation index. Inflation goes up, you pay more, and you pay more capital at the end. Inflation goes down, and potentially you actually win as a government borrower. So that's a very familiar, well-trodden path. The much more new invention in this situation is what's being referred to as a sustainability-linked bond. Now, this has been very popular with corporates already. Market's still quite small, but there's strong evidence that it'll grow very rapidly because it's much more flexible. You don't have to promise to use the proceeds for a particular use. You just have to say, we will comply with certain KPIs. Now, if we go on to the next slide, we can have a look at this in a little bit more detail. So, as I say, the use of proceeds is unrestricted. That means the project doesn't have to be a specific project. So immediately, as a smaller borrower or a country, you've automatically expanded the envelope in terms of sort of how much you're borrowing, because you're not restricting it to a particular project. You can combine things that might be regarded as sustainable with things that are not, which is also really useful for smaller borrowers or for businesses that are in transition, where their current sort of projects and business model might not really satisfy sort of green criteria, but they're aiming to get there. well, you can use one of these bonds as a way to help you. So it still has that sort of sustainable or green flavor to it. It still has a sort of a green objective, if you like, if you want to use green in that rather broad way, but it's got far fewer sort of constraints within it. Because instead, you are linking to what is usually referred to, again, a bit of jargon here, the sustainability performance targets. So rather than talking about KPI, which might be a term we're familiar with, of course, the investment bankers who invented this product decided to come up with a new term so they could charge a little bit of extra, and they call it a sustainability performance target, or SPT. Now, an SPT could be something like, we will reduce our carbon footprint by X% within Y number of years, or we will make sure that our sort of senior executive board becomes more diverse by this percentage, by this target date, or it can really be whatever you like in terms of the target. There are some principles around this. The ICMA has produced sustainability-linked bond principles, and so they say that the sustainability performance target should be ambitious, not business as usual. So the fundamental view is that it should be something you have to stretch to achieve, not something you were going to do anyway. Little bit of a debate about the extent to which perhaps that edict is being sort of obeyed, if you like, in the markets, but that's the principle. You obviously have to work out how to measure it reliably. And again, we have a monitoring process, which will usually be external monitoring. And then, of course, we have to have reporting as well. And then ultimately, you will actually have a cash consequence, which is what makes this type of bond particularly interesting. So failure to meet the target at the specified date will have a consequence. And if we go on to the next slide, we can see what the consequence might look like. Now, the basic framework, certainly the one that's been used by corporates so far, is actually very simple. You have one measurement point, roughly halfway through the life of the bond usually, and if you've missed the target, your coupon will step up. 25 basis points, which is not frankly very much, has been quite common in the corporate arena, but you know, as they say in the adverts, there are other sort of step-ups available. So you could certainly pick one that was a little bit more meaningful. The principles themselves say that the step-up should be noticeable in the context of the coupon. So a 5% coupon illustrated here, 25 basis points, probably on the boundary of being noticeable. If it was 50 basis points, that might sound like something with a little bit more bite. But of course, from a lender's perspective, bear in mind, you don't really want the company to sort of go bust or suffer financial stress as a result of missing this target. So there's a balance to be struck with making the sort of the pain, if you like, noticeable, but not too painful. So that's the structure that's been used with a lot of corporates. Now, you could, in theory, have something slightly more complicated, which is illustrated by the diagram on the bottom right-hand side, which is where you would have a series of measurement points and a series of step-ups or potentially step-downs as well. Something would actually look much more like an inflation-linked bond, where obviously, in the UK example, every 6 months, the coupon will step up or down as a result of changes in inflation. And you could very easily structure something like that in a sustainability-linked bond as well. There's no corporate, as far as I'm aware, that's done that yet, but certainly a couple have sort of made that possible within their overall bond framework. So how do we put this into the sort of context of a sovereign bond and thinking more about the potential for something linked perhaps to deforestation? Now, part of the challenge for sovereign issuers, as opposed to corporates, is, well, who should receive the penalty payments? Should it be investors? That would be the straightforward answer. If you're copying the corporate example, you say, company didn't meet the target, investors get a bonus, and you'd say the same for a government. But of course, there are some sort of political and what you might call perceptual challenges there with a country perhaps failing to meet a target, and then you could imagine it's an emerging market country failing to meet its target, and then sort of developed market pension funds getting wealthier as a result of a sort of a failure happening in some sort of emerging market. And it starts to smack a little bit of economic transfers going the wrong way from a development perspective. You could use a separate fund. We'll come back to that sort of idea in a moment or two. The step up appears to be rewarding investors for the adverse impacts of missing the sustainability performance target. Well, I mean, that is absolutely what's happening. You could regard that actually as a sort of quasi hedge. So you could think to yourself, okay, I'm an investor in a country which has promised to meet these development targets, for example. It's failed to do that. That might have a negative impact on the price of the bond in the market. So I'm now losing money, but the step up in the coupon gives me an implicit hedge. So there are some arguments as to why you might say, yes, investors really should be getting the reward from the penalty payment being paid by the sovereign. Clearly, a step down is going to be easier to sell internally. If you imagine yourself as the sort of, the senior Treasury Minister explaining to the sort of your cabinet colleagues or your president or whatever the government system is that, you've designed a bond which makes life more expensive for the country if you fail to meet these targets, that's quite a hard sell. Whereas if you say, well, if we meet these targets, lo and behold, our interest cost goes down, that seems a very easy sell indeed. So, and the other side of that, of course, is you might have to spend more money to actually achieve the target. I mean, again, going back to the basic idea, this should be a stretch target. That suggests that potentially we'll need to invest more in, environmental compliance or monitoring, or more people in a particular civil service department, or whatever it might be, to meet this particular target. And lo and behold, you're then getting a sort of subsidy. It may not be pound for pound, but you're getting some sort of payback through the bond structure because you're paying less interest to the international markets. The third thing to think about is, again, going back to that sort of illustration previously about the coupon change. As I say, most corporates, all corporates to my knowledge, have structured it with one sort of measurement point and one step up. The challenge here, imagine a situation where you've got a 10-year bond, measurement sort of point in 5 years' time, and your government has 4 years still to run. Quite a temptation to say, well, 5 years is beyond the election time horizon, sort of who cares? Maybe the polls also already illustrate we might lose. So, hey, let's sort of ignore that environmental target and go for broke in terms of, pork belly politics and trying to buy ourselves votes, and we'll deal with the consequences later. So there is potentially an argument for saying, actually, with a sovereign bond, it makes more sense to have more frequent measurements and therefore also more frequent sort of coupon changes. Let's have a look at deforestation-linked sovereign bond more specifically. Now, just to give credit where credit's due, we are very much sort of midgets standing on the shoulders of giants. Michael Manielli, not far removed from this parish, first came up with the idea of policy performance bonds in 2005. Much more recently, an organization called the Finance for Biodiversity Initiative started to tout the idea of nature-linked bonds, and the World Bank has picked up on that and started to talk about sustainability-linked bonds for sovereigns in their sort of recent publications. So really all we're doing is saying, okay, well, let's actually look at a practical example of a specific sustainability performance target and a specific, very serious environmental issue, and link the sovereign bond to that. And that's the sort of concept behind the deforestation-linked sovereign bond. Now, here's the diagram that you would expect every good corporate financier to be sort of throwing around in their PowerPoint pack. It's a very simple sort of concept. The investors are giving unrestricted funding to the issuing country in just the normal way they would in any other sovereign bond issuance, dominated in dollars or the local currency, depending upon market structures. The issuing country is obviously then going to establish the sustainability performance target. In this case, we're suggesting it should be deforestation. And picking on Brazil, for example, in Brazil's nationally determined contribution, their sort of statement about how they're going to meet the Paris goals by 2050, one of the things they've already said is they will achieve zero illegal deforestation by 2030. So you could have that sort of framework, and you can begin to see how that could align with some of the other things that you've said in your sort of national statements and national policies. You have a measurement process. You will need third-party verification. Again, that's going to be a slightly contentious, sensitive topic for some sovereigns, having an outside body coming in, but there may be one that will be politically acceptable. And then clearly there's going to be a reporting regime that you need to build in, and that will be very important because that will be published on Bloomberg, Reuters, and all the other sort of information streams, and the market will then obviously react to that. And once that sort of report comes out, then the coupon will change a number of weeks or a month after that sort of measurement date. and that coupon obviously getting paid to the investors. So far, so sort of so simple. One of the things that could be done to alleviate some of the challenges is actually to interpose a sort of a third party into the mix. So if we have a look at the next slide, let's think about some of the advantages of a deforestation-linked bond before we think about some of the sort of complexities. The key advantage that we believe is quite a big one is that the issuing government is now financially incentivized to align their subsidies and their tax regime with that stated policy objective. So it actually starts to give a real financial impetus to effectively put your money where your mouth is. So you've said, yes, we can achieve this wonderful environmental goal in 2030, so beyond the next electoral time horizon. Well, now you're structuring a bond around that, potentially with a series of measurement dates and potentially with a series of coupon changes and all the reporting associated with it to the financial markets outside your own political environment. So you're suddenly making yourself a great deal more accountable to sort of external view, if you like. Clearly, citizens and businesses have an indirect stake in success because there will, pretty marginal, and you might not notice it really in your tax burden, but there will be an economic effect on the state as a result of failure to hit the target or success in meeting the target. And so that creates a bit more potential buy-in or at least interest amongst the citizens of the businesses within the country. It's a great way to really make clear that your intentions are actually serious because you are literally sort of putting your money where your mouth is. You're actually tying your treasury framework to this policy statement. And of course, the other thing that you're helping to do, and we've seen this already with the driving behind the green gilt and the other green bonds that have been issued by different sovereigns, you're helping to establish that ESG labeled bond curve, which can then be used by companies and banks within your sort of jurisdiction as a way of stimulating that overall growth in sustainable finance. And that's a huge area of growth and definitely one that countries should be looking to exploit and sort of effectively jump on that bandwagon. This would be a really helpful part of doing that. And then final couple of things, the governance and reporting mechanisms that you have to build for your DLSB will automatically have a sort of strengthening effect on civil society. You will be building in reporting mechanisms. You'll have to be employing civil servants or other people to go out and actually look at this environmental thing that you're focused on, deforestation in our example, but it could be other things. So you'll automatically build in that framework, which you can then use. You can use that machinery for a whole variety of other purposes, environmental purposes within your sort of state mechanism. The last point that's worth mentioning, and I want to talk about this in a little bit more detail, is you could combine this bond with an aid package. Now, particularly for emerging market economies, for developing economies, they will often be looking to get aid from outside, and they will often want to sort of attract that aid by making sure that the aid providers, the donors, can be satisfied that the sort of the governance regime is being properly sort of built, and the aid will be used for the purpose to which it's actually been given. And a DLSB, a deforestation-linked deforestation-linked sovereign bond, or another flavor of sustainability-linked sovereign bond, could be used in combination with an aid package. And it could also be used to help with some of these sort of question marks around, you know, who gets the rewards and who doesn't. We have a look at the next slide. Final one, so nearly at the end of my chatting, and then we'll throw it open to questions. So here what we've got is we've got an aid agency involved in the process as well. Now, this is just one potential way of doing it, but what you could see is you could see that the failure to meet the sustainability performance target results in a coupon step up, but the marginal increase goes to the aid agency rather than going to external investors, and that potentially meets some of the political question marks around, oh, you know, rich Western investors getting rich at the cost of a developing market which is struggling to meet its targets. On the flip side, what happens if you meet or beat the target? Well, if you were going to have a step down feature, then you're asking the international capital markets to effectively give up some of the reward they were expecting from your bond, and that might be quite an unattractive prospect for them. That also might cause all sorts of portfolio challenges, and it might mean that the bond didn't feature within standard indices, for example. So it creates some challenges from a financial markets perspective. What if the standard coupon carried on getting paid to investors, and effectively the aid agency subsidized or passed money back to the issuing country as a reward for compliance or for beating the target? So it's effectively funded by international donors, but it's being structured within the bond to create this sort of rewarding mixture which works well for the financial markets. And then on the side, now you've got this great governance structure built up for the DLSB. You can layer a whole load of more aid onto the top of it, and then effectively put the country into a much stronger position to actually meet the requirements to meet its targets that it set out in the DLSB in the first place. So the whole framework could become much more coherent and a much sort of tighter governance structure. And remember, because this is going to be probably something like a 10-year bond rather than a much sort of shorter time frame, it's a way of making sure that you can bridge that electoral jump from one government to another, one regime change to another. It's just giving you slightly more credibility that a change of president won't undermine the whole sort of whole regime that you're putting in place. So that's the basic idea. There is a report that we've published, obviously, that can give you a lot more information, and you've got the link to that. But I'll stop talking now and throw it open to questions and hand over to Simon to collate and pass on the insights that he can see on screen.
Fantastic. That was absolutely fascinating, Peter. Now I've got loads and loads of questions on the screen, but I've got a couple that I'd like to pick up on. The last bit you were talking about with regards to aid and so on. A long time ago now, I did a lot of work on carbon trading in the City of London, and one of the instruments of the Kyoto Protocol was the Clean Development Mechanism, and reforestation was one of the strands of that. It strikes me that there's a potential for double bubble here for developing economies if they're issuing index-linked policy bonds and linking that to the Clean Development Mechanism. They can actually pay for reforestation projects and gain the uptick in their targets as well.
Yes, absolutely. I think they definitely can, and I think if you were being a little bit cunning as a developing country, I mean, we take Brazil as an example. They've got massive sort of natural capital resource, including obviously the Amazon that everybody knows about, but a number of other really important sort of natural assets, and simply using those as sort of carbon sinks, for example, and monetizing the carbon benefit, you could effectively, if you were clever, get paid or get finance a number of times over against the same natural capital asset, actually, because you're effectively providing value from that asset to different parties in different ways.
Absolutely. So, perhaps one of the things to consider is additionality as well when you're looking at deforestation bonds.
I think that's a good point to make. It has potentially a sort of multiplicative effect, if that's the right word. Yeah.
Given the increasing physical risks there are associated with climate change, and I'm thinking of wildfires in particular, do you think there's a need for new insurance products in order to actually hedge the risks for these type of bonds?
Yeah, it's interesting. I guess it sort of depends on who you think is hedging the risk. There would be another risk created if we allowed, let's again take Brazil just as an easy example. If we allowed the Brazilian government to make a promise that it wouldn't deforest, and then it bought an insurance product that said, well, it doesn't matter because if we do deforest, we get paid and we can use that to pay the extra coupon. That seems to be sort of undermining the whole concept. But I think your point is a valid one in broad terms, that the physical risks around this and frankly any bond which is linked to sort of natural capital linked to the environment, there are things outside your control, whether you're the investor or whether you're the borrower. And so having insurance products that will help to protect against those sort of unforeseen risks will be important. Having very clear delineation in the bond terms as to what we're responsible for. So what counts as deforestation? Is it wildfires? Well, yeah, but maybe we need to work out who started them, as it were. So it does get quite challenging, but you need some sort of clear definitions in your bond terms. And insurance, I think, is definitely something that that sort of comes alongside a lot of this. It feels to me as though the insurance industry is very much at the cutting edge of a lot of the debates in the capital markets around sustainability, because ultimately, as we can see from the fires in California and the floods in Germany and Austria, they are picking up the tab for the environmental effects that sort of the rest of the economic system is creating. So I think insurance is definitely sort of something to watch in this space.
I've got a lot of questions here around data and how you actually measure performance, but there's an interesting one here, which is saying how is environmental and social return on investment measured? So, for example, how can you ensure in the case of Brazil that the rights of indigenous people are protected when this sort of bond is issued and billions of dollars are tied up in its success?
Yes, that's a really good question, and I think the rights of indigenous peoples. It's interesting. I've seen a very strong shift in terms of the capital market attitudes towards this. I think in the past it was regarded as a bit of sort of, oh well, that doesn't matter. A bunch of sort of people living in the woods, not like me, driving my Ferrari around Wall Street or whatever. But actually, I think there's a very clear acknowledgement now that the indigenous peoples are generally very, very important for the management of natural capital assets, and that actually, if you interfere with a forest like the Amazon, you are automatically harming a variety of people groups that live there and rely on it. But flipping it round, if you rely on those people groups to help you actually sort of manage the natural capital asset, they will do that much lower cost and much better than sort of outside intervention. So there's very much a feedback loop between the two. The thing to be aware of course, with the deforestation-linked sovereign bond is that as we've configured it in this broad way, it doesn't have a specific sort of sustainability performance target linked to how you're treating indigenous people. So at its very simplest, and this would be true for a number of sustainability-linked bonds generally, they are very clearly targeted at very few sort of SPTs. And generally speaking, you want to keep it relatively simple. But having said that, there's absolutely nothing to stop you having 2 or 3 of these performance targets, one of which would be some sort of aspect around how you are treating indigenous sort of peoples and their rights.
And presumably,
but within the bond framework and the sort of governance system that you'd have to have, I think part of the reason why we think this is a good idea is you'd have to build quite a solid framework around this bond to actually give it credibility in the capital markets, and indigenous population rights will be part of that, I think.
And presumably, actually, the measurement issue is incredibly important because, for example, 100 acres of virgin rainforest in terms of biodiversity is worth a lot more than 100 acres of oil palm. So, a government which cut down the rainforest to plant oil palm, the acreage of forest is still the same, but the biodiversity value is a lot less. So can you build those kind of measures into your performance bonds as well?
You can, and I think you should. I mean, it's interesting. If you look at an inflation-linked bond, you have an index which is driven by a sort of a basket of goods, and there's very clear sort of a agreement, if you like, around that. So you've got a value component coming in, which then drives the coupon. You could, in theory, try and value the Amazon or another forest, and as the value changed, you then have the sort of the value of the bond or the value of the coupon changing as well. I think that would be quite complicated. But you could have a quality measure that's much easier. And we already have the technology in terms of both satellites sort of, from the sky and people on the ground to assess the sort of the biodiversity and the quality of the diversity of the forest itself and the health of the trees. So you can effectively say, right, well, this is the definition of a healthy forest. And you can then do that on sort of, 100-meter square units or whatever. I mean, you can really get it very, very granular. So you can actually have an assessment of not only the quality of the forest, but also its acreage as well. So you can have that sort of 2x2 matrix, as it were, which could then drive, that could be your sustainability performance target. And you could either have sort of failure of one or the other, or you could say you've got to meet both of those. So you've got to be sort of top right-hand side of the matrix in order to qualify. So yes, I think I'd hesitate to say it's easy. Conceptually, it's definitely easy. Practically speaking, it's a bit more of a challenge, which goes back to this sort of, governance, reporting and measurement process, but it's definitely doable. People are already measuring the quality of forests and the sort of the size of the forest at the moment. So we have that machinery in place already.
Excellent. Now I've got some technical questions here. These have very much got a financial flavour. With reference to sustainability bonds, and I presume these are the corporate bonds which people are familiar with. What's the normal duration for this type of bond? And have they got a call option as well?
That's a really good question. I don't believe that they have a call option. I mean, I have to confess, I haven't dug into sort of hundreds of these things, and the reports that I've read in terms of market reviews haven't talked about this. But the few that I've looked at didn't have a call option in as such, so they couldn't be sort of redeemed early by either party. And in terms of the duration, yeah, that's quite a hard question to answer. My impression is, and again, this is based on sort of just random reading rather than proper statistical analysis. My impression is that the bond tenor is between sort of 5 and 10 years in the corporate world. So sort of duration sort of 4 to 8. So they're towards, certainly the corporate ones are towards the shorter end of the curve, but they're definitely not sort of short dated, as it were.
And what about credit ratings? I mean, presumably people like Moody's and Standard & Poor's have had to work out a whole new approach to assessing these instruments. What kind of credit ratings are sustainability bonds getting at the moment?
Yeah, well, that's interesting. I mean, actually, the credit rating process is essentially identical, because ultimately, you are looking at the cash flow prospects of the issuer, and then you're looking at where the bond actually fits in the sort of capital stack, whether it's secured, unsecured, and all of those other sorts of things. So the sustainability linkage, or indeed, actually, if you were just going back to a use of proceeds bond, as we were talking at the beginning, that's not in itself determining your credit rating. So the credit rating process itself is absolutely identical as far as these bonds are concerned. They don't trade away from if you like the straight bond that they might be sort of compared to by the same issuer.
Okay.
But in terms, I should qualify that though. Having said that, if you're looking particularly at the sovereign bond market, where you've got some very clear benchmarks of sort of non-ESG and ESG, so the green gilts and the equivalents have definitely traded tighter than the underlying sort of bond curve. So the government is getting a cheaper source of financing by issuing an ESG use of proceeds bond than they would if they just issued a straight gilt or Van Briefer or whatever it might be.
Yeah, it's the halo effect, isn't it? I mean, I hope that in 5 to 10 years, when this sort of bond is commonplace, there won't be that differentiation. It will just be
I think what you'll find in 10 years' time, or even probably I would guess more like 5, is that actually the sort of let's use green because it's a shorter word. The green bond issued by a sovereign will be the default, and if you issue a dirty bond, that will trade at a discount, or a premium in yield terms.
Absolutely. Right, hold on. Here we are. We've got another technical question here. That's the SDP. Could the STP be set or translated to a standard measure that can have a visible market price? For example, dollars per ton of CO2 equivalent.
Yes, I think it could. I mean, again, sort of frankly, the challenge outside the carbon space or the climate space is that at the moment we don't have a sort of a nicely agreed metric like CO2 equivalent and then a carbon price. So if you're looking at sort of climate related things, you can say, what's the carbon footprint, what's the carbon price, bang, there's a number. You can't very easily do that with other things in sort of, broader nature, if you like. But conceptually, yes, you absolutely could. So you could have some sort of qualitative measure of the forest, which you translated into an ecosystem services value, and then that could actually ultimately translate into a price. So if you really wanted to run off into the wilds of the financial markets, you will probably find at some stage some clever banker stripping out the SPT element and trading it as a separate derivative. But we're definitely not there yet.
Right, here's an interesting question. You've touched on this. How important do you see Earth observation in monitoring? What advances are required? Are we actually there yet to be able to provide the data required to cover this type of instrument?
Yeah, I think we're there. I mean, it's extraordinary. If you look at what some of the satellite companies, and these commercial satellite companies, obviously not sort of government bodies. I was looking on the website of one of them the other day, because they're always touting to us to try and get us to sort of then explain their wares to everybody else and charge them lots of money. They were getting down to 50 centimeter square units in terms of how high the definition. And these are commercial satellites. So you can bet the bottom dollar that, the sort of US spy satellites are absolutely sort of, reading the text on your phone when you need to put your glasses on to read it. So yeah, we've got the technology, as they used to say in the old TV series, we've got the technology. And not only have they got that sort of high definition, but they've also got the ability to sort of, use beyond the visual spectrum to look through clouds. They can use a variety of techniques to assess different crop types, different tree types, water content of the soil, water being given off by the trees. I mean, it's absolutely extraordinary what can be done. And Brazil, one of the other reasons why we pick on Brazil, Brazil has a lot of this tech in place already and is doing it. They have a very advanced space agency and very advanced satellite capability, which they're already using for environmental monitoring purposes, sort of in spite of the funding cuts that the Bolsonaro government has imposed on those recently, but the tech is already in existence.
And in terms of financial services, Brazil is well ahead of the curve in terms of sustainability and SRI and ESG as well. So yeah, it's interesting times in Brazil. Now, question here: could the aid agency you referred to be the World Bank? So how could the World Bank be actually involved in supporting this type of instrument?
Yes, it could be. It could be the World Bank. It could be a sort of, some sort of pooled escrow type vehicle, which was set up by different countries. So, there is something called the Amazon Fund at the moment, which was mainly supported by Norway and Germany as an aid fund focused, as the name suggests, on the Amazon. Could very easily be the World Bank. And as I said earlier at the beginning, they are already looking at sustainability-linked sovereign bonds as a broad topic. So they're very interested in this sort of financial technology, if you like. And you could imagine sort of aid or subsidized lending coming alongside. So sovereign, you issue this bond, make some promises, we'll give you some subsidized lending as well, and we'll sort of arrange an aid package on top. So you could see quite complicated package deals being put together for countries. And because this sustainability linked sovereign bond isn't restricted in terms of the use of proceeds, then size becomes less of an issue as well. So it's more simple to create something which is sort of liquid in the market. You could also actually, if you wanted to, flip it around and have a bond which was issued by some collective vehicle on behalf of a number of developing countries, which were all effectively promising to meet the same sustainability performance target, perhaps around something like education, for example, or water use.
That's a really excellent point, and I think we can leave it on that, Peter. Thank you so much for a fascinating and insightful chat. Time has really flown, but I'm sorry that we have to say farewell. There's just time once again to thank our sponsors and to remind you of some of the FS Club's forthcoming events. Tomorrow you can hear a webinar entitled All Party Parliamentary Groups, What Purpose Do They Serve? What purpose indeed. On the 23rd of September, we've got a really scary one entitled This is how they tell me the world ends: the cyber weapons arms race. Don't have nightmares. And finally, the next edition of the Global Financial Centres Index will be launching on the 24th of September. You can find out about these and all our other webinars on our website. Peter, ladies and gentlemen, thank you very much for joining us, and thank you for your time.
Thanks for having me.